The title of my paper is New Digital Currency, Central Bank Digital Currency, CBDC, Monetary Policy Tool to Stop Inflation Without Causing a Recession. Adjusting interest rates on Wall Street is ineffective in stimulating and too brutal in slowing the economy. But injecting stimulus money and adjusting interest rates on small individual consumer Federal Reserve digital currency bank accounts could impact consumer demand more effectively and more immediately. And you can watch this YouTube video on FedAccounts to get the idea. Okay, so next we have this economy is a common property resource. So this is very important, and it talks about how if you have a single owner of the island economy in terms of owning the stores and everything, then that single owner has an interest in maintaining an adequate money flow in the economy. But if you have separate businesses, all of them want to act as free riders in having the others increase wages for the employees and money to pay the suppliers, but none of them wants to do that as themselves. So it's a common property resource problem within the economy is maintaining the proper money flow, so not too much money, but not too little money. And that is a common property resource, which we need to understand and use that effectively. Okay, so the next problem is understanding that in Adam Smith, there's actually two invisible hands. He only explicitly refers to the one invisible hand, which is economic competition, to lower prices and increase quality of goods and services when we compete, in trying to maximize our profits. But he also talked implicitly about a second invisible hand, where the producers get together and conspire with one another to try to make prices higher and restrict competition. So there's really two invisible hands in Adam Smith. Although we tend to emphasize the first invisible hand, we should also recognize and understand the second invisible hand. And the U.S. economy has become less competitive in recent years. And Jonathan Tepper has a great book called The Myth of Capitalism, which should really be called The Myth of Competition, which lays out the dramatic drop in competition in the United States. And just like eyeglasses, there turns out to be two major producers of eyeglasses. I mean, they're just glass and plastic. Why do they cost so much? Because there's only two major producers. And you'd be amazed to discover that there's really only two major producers of beer in the United States. I mean, there's industry after industry. So we need to understand this and appreciate what's going on. Hyman Minsky brought out this disequilibrium economics, and most goods and services compete, and everything's great. But within the financial economy, there's a tendency, instead of negative feedback loops, we have these positive feedback loops that create these financial crises. So we have to understand that. We have a distorted money flow. The fundamental problem is that there's so much money has been flowing to Wall Street that there's not enough money left on Main Street for the people on Main Street to buy back the goods and services they're producing. So they go deep into debt, and then that's not enough. So then the federal government has to go into debt. So we have to understand that. Public and private debt. The decline of union power. That's the second invisible hand, right? Adam Smith's second invisible hand is economic power. And this decline in unions, the Citizens United, so special interests get all this direct all this money to go to Wall Street instead of going to Main Street. And so they can't buy back the goods and services, go deep into debt. And very interesting research, empirical research by Simcha Barkai. What he's discovered, I was thinking that, okay, so we have all this automation, robotics, everything. So instead, less money going to labor, more money going to capital. But what I didn't understand is there was actually even less money going to physical capital because the financial capital was dominating. And so the revenues were really going into pure profits. And it's because of course, the lack of competition and so forth. But it's amazing to discover the empirical research showing how extreme this has been, that I didn't really understand the extremity of what we're talking about. So you want to check out this in the Journal of Finance, this special case. Okay, and the financial economy has become separated from the real economy to some extent. And so when the velocity of money, for example, going around and around, and the financial economy going faster and faster and faster, is having more and more financial products and derivatives, and they're trading faster and faster, in nanoseconds, trading and so forth. But in the real economy, the velocity of money is actually slowing down. And that's something that's important to understand. There's also the zero marginal cost economy. Adding another user to Facebook is almost a zero cost. And they say, on ResearchGate or Academia.edu, we have these, if you sign up for the higher level, you pay some money, but you get the immediate access to the information. Well, that information's already there. It's just a matter of them changing it 0 to 1 and you paying the money. Well, there's no cost really for them to provide that because the information's already there. They're just revealing it from changing this 0 to a 1 and getting your money. Then we have this very amazing paradox, this natural selection paradox that's going on, where, as I teach economics at Notre Dame. I've taught economics at Notre Dame for 30 years. And then one day I had trouble getting their attention, the students, because there had been a football game the weekend. It was a Monday morning, So I said, well, today we're going to talk about birth control. Birth control? We're going to talk about birth control. And I said, yeah, we're going to talk about birth control. This is Catholic University. You can't talk about birth control. Yeah, I can. So then I said, well, wait a minute. What we want to do here is recognize that when per capita income hits $6,000 per capita and higher, birth rates drop like a rock. And this is really a weird thing where it's the richer we get, the more educated we get, the lower the birth rates. So as we get lower and lower birth rates, eventually we won't have any people. And so, the last one to die, remember, turn out the lights. So it's a weird thing. Okay, anyway, then we have the money flow paradigm. Very exciting paradigm, a new paradigm, somewhere between the Marxian and the Keynesian paradigm, where it recognizes the role of government in the economy. The government plays a tremendous role in maintaining and enhancing the efficiency of the economy in many ways. So government is in many situations the only one able to properly set marginal costs equal to marginal revenues, to marginal benefits, the marginal cost to marginal benefits. So we get that equilibrium, and the government has been behind these tremendous increases in productivity. And this is all laid out in Mariana Mazzucato's 3 books, Entrepreneurial State, Value of Everything, Mission Economy. Got to read those 3 books to understand the role of the economy, the role of the government in the economy. Now, the money flow paradigm challenges the old quantity theory of money, Milton Friedman's NV equal PQ. And what it's basically saying is the velocity of money actually is falling in the real economy. And it's falling as people age, they get older, they reduce their spending generally, and they have healthcare, of course, increases, but their general spending, goods and services tend to decline. And the velocity of money falls as economic inequality becomes more extreme. As more and more money is going to the wealthiest people who don't really spend it, they just put it into the market, the stock market, driving up, stock market and bond market and so forth. And so we have a situation where the modern monetary theory is actually correct in saying that we need to pump up the money up to a certain point. We don't want inflation, but we need to counteract this falling velocity of money that's going on. And then finally, let me get to the real issue I'm focusing on, the most important issue that I'm focusing on in this paper. We don't want to repeat our historically dysfunctional approach to stopping excessive price inflation. When the Federal Reserve raises interest rates in New York financial markets, it becomes harder for businesses to borrow, which causes businesses to cut hours, lay off workers, and close outlets. This is an indirect and rather brutal way to reduce demand for goods and services that also reduces supply. The effect is to make it harder for firms to increase supply and harder for people working paycheck to paycheck to handle medical emergencies, automobile accidents, or afford a mortgage. We don't need to use a cost of borrowing tool that punishes the poor to reduce inflation when a central bank digital currency could be used to create a return on savings tool to directly reduce consumer demand on Main Street. Sure, suppressing business to lay off workers to reduce demand will work if you slam on the brakes hard enough, but trashing the economy to stop inflation is not necessary. A more direct, a more efficient, and a more effective way to stop inflation is possible by creating Federal Reserve digital currency bank accounts for everyone. We all have Federal Reserve notes and coins, but only the largest banks, there's about 24 of them, have Federal Reserve digital currency accounts. Ledgers for unsupervised digital currencies require a blockchain, but private banks and governments provide direct authority and responsibility for issuing digital money. The Federal Reserve issuing a digital currency means allowing everyone to have an account with the Federal Reserve. But the Fed offering a high enough interest rate on savings to curb inflation could divert enormous amounts of money from the private banks and Wall Street. To prevent this and focus on those with the highest marginal propensities to consume, in other words, the poor and the middle class, the accounts eligible for the high interest rates would be limited to one account per Social Security number, with that interest rate applying only to amounts up to $10,000. A similar restriction was imposed under the Postal Banking Act of 1910, which allowed individuals to have a savings account through any local post office for over 50 years, from 1911 until 1966. Such a savings account would allow for smartphone to smartphone transfers, as you could pay someone to rake your leaves or cut your grass directly and immediately from your Federal Reserve savings account. If the Federal Reserve created central bank digital currency bank saving accounts for everyone, the Federal Reserve could have a return on savings tool to directly impact consumer demand on Main Street to reduce demand pressure to stop inflation without throwing the economy into recession. Currently,